Alrighty, let's go ahead and get started. Welcome everyone to TradeFinder Live. It's great to be back with you all during this trading day and during trading hours. First and foremost, as always, we do need to cover our disclosure disclaimer agreement. The main thing to take away from this is that we are not licensed investment advisors in the United States, so nothing to be taken as personal investment advice. This is always available on our website to be read in full detail at your leisure, or feel free to take a screenshot of it now if you like, but that's the main point to take away. Some interesting headlines, one of them being that OpenAI is under pressure as Google's Anthropic gain ground as a competitor against OpenAI. We had the news yesterday with Eli Lilly cutting their prices for their weight loss drug. So some big names and some volatility that may be implied coming in for those stocks after. So interested to hear Rob's thoughts on that amongst many other topics. And of course, very excited to interact with you all. So let's kick off. Rob, how you doing today?
Good, Zach. How are you? Hey, everyone. Welcome to this edition of TradeFinder Live. Hopefully everybody had a great Thanksgiving holiday weekend, at least for those of you that are here in the U.S. and celebrate the holiday. Those of you that are outside have to deal with the market closures, etc. We're going to talk about that in just a moment. So hopefully everybody can see the chart now. And I did want to show you where we are, because I think it's pretty interesting with the setup right now. We did get important news. I received a notice from the data scientists at Hub that liquidity did tick up. If you watched last weekend's U.S. market update, which hopefully you did, there had not been updated liquidity data from the Fed, which in my mind left a question: did they follow through with what they said they were going to do? But then the data came in over the weekend, and apparently they did. And just to note, liquidity injection is not an instantaneous thing to the market, but it does affect the markets much faster than a rate hike or a rate cut. As I've mentioned in the past, rate hike and rate cuts from the Fed do affect the banking sector immediately for overnight lending. That's really what that rate is for. But it takes a while for those to work its way through the economy, for banks to lower their interest rates, for consumers to borrow. And it just takes a while. And then they have to spend that money. So injection or withdrawal liquidity are much quicker, even though it's not an instantaneous thing, as I mentioned. But you're seeing some of that in some of the stocks that I'm sure will feature in this edition. So here we sit, moving back to the upside a bit, kind of exactly what we thought. We did a quick speculative alert for our subscribers at Evo Trader on Friday, expecting a tick down on Monday. That was due to the volume scenario that occurs oftentimes during holiday shortened weeks, because especially now when traders have morphed the Thanksgiving holiday into a 5-day weekend that take off Wednesday, Thursday, and Friday. The markets open on Wednesday, but only half a day on Friday, and they just kind of turned it in that way. And we had movements to the upside following along with that old adage, never short a dull market, meaning when volume is lower, is what a dull market means. And I showed that we had this move up here. So I'll just draw an arrow this way on the move up that occurred during that week. And then you could clearly see the lower volume. There's the divergence. And then you see what happened yesterday. There was the red bar on the down day yesterday. So it was just a quick hit, a small 5% gain, but it's kind of one of those things that I've noticed over the years that occurs, and quick in, quick out, and worked out pretty well. So we opened on the low, traded higher, closed near the low, but ticking back up in this morning's trade. So far, we'll see how that finishes out. What we need to watch, in my opinion, is a little bit of a trend line that may or may not be forming. And that's right here, where you see that, at least at this point, we have a set of lower highs. But if we break above that, then I think that's the key. So I'm going to leave that trend line on there. Watch and see if that line gets broken. then I think maybe we are on our way to a wave 5, but the algorithm is still holding that wave 4 green, which is interesting, which means it's still active. And based on the price action that falls within the Elliott Wave algorithm that Mr. Elliott wrote, not convinced that that wave 4 is done. Maybe it is, but not convinced of it just yet. So we'll keep an eye on that as well. We do have a bullish 1030 cross there. As you can see here, the lime green line breaking above the fuchsia colored line. The lime green line is the 10-day, fuchsia colored line is the 30-day. So we've broken above that. We are still a little bit overbought, as you can see from the 10-day moving average. So this kind of sideways action is actually pretty healthy. I was surprised. I thought we might open and trade a little bit lower yesterday, but we didn't. That's why it's only a small 5% gain. But in one day, 5% a day, we'd take that, wouldn't we? So now we watch and wait for this trend line to be broken for a little more confirmation. And then, of course, we'll want to see if we finish to the upside today, what does the volume look like? Obviously, early in the trading day, so that volume bar is going to be low. We'll want to see where that is in the close, and you'd want to see it above yesterday's red bar. That's what you'd be looking for. You would want to see today's volume on an up day exceed the volume yesterday on a down day to give us a little more confidence. The reason that I'm probably sounding a touch more bullish, somebody wrote on the U.S. market update that I was a perma bear, which you couldn't be anything further from the truth. I have made comments that I do like trading in down markets because everything moves faster, especially in the world of trading options where time decay is an issue. When things move faster, time decay is a lot less of an issue. But that doesn't mean I'm a bear. It's just an observation. I realize more people make money when the market goes up. We all want the market to go up. People have retirement accounts sensitive to that. So I'm in no way, shape, or form a perma bear. All I do is try to analyze what the charts are showing to the best of my ability. And that's it. I don't really have a preference one way or the other, or a convicted view one way or the other. The markets are the boss. And I learned a long time ago that the more you learn, the more you think you know where the markets are going to go or should go. And if you start trading by where you think the market should go, then you're not going to be very successful. You have to listen to what the markets tell you, because that's all that really matters. Doesn't matter what your view is, my view is, anybody's view. All that matters is what the markets actually do. So we'll watch a little bit of consolidation here, maybe for another day or two. Actually, it would be pretty positive, and then break. I wouldn't really want to see the market take off when we're already a little separated from the 10-day moving average. I'd have less faith in that holding. As you know, I tend to give a conservative and an aggressive view when applicable for potential entries into charts, stocks. In this case, the aggressive move would be a break above this trend line, and it would be aggressive because of where the 10-day moving average is. It'd be a lot less aggressive if we go sideways for a couple days, let the 10-day moving average catch up a bit, then take off. But then the more conservative view is not that much different, a little bit higher. We would wait for this wave 3 high to be taken out. And of course, we would want to see some decent volume. It doesn't have to be huge volume. In fact, you don't really want it to be huge volume, because usually when you get those big volume spikes, that means the buyers or sellers, depending on whether it's a up day or a down day, or short-term exhausted, and you get a little bit of retracement or pullbacks after that. And we don't want to see either one of these trend lines broken, in my opinion, when we're a little bit overbought. So this is pretty good price action, in my opinion, on where we could go from here. What's been wild to watch has been the bond market. And it was noted this morning on the financial networks, and I actually opined on this a little bit yesterday during our EWO Trader live segment for our alert subscribers at EWO, was the interesting slight difference in what's going on in the bond market now. I've been talking for, gosh, I don't know how far back we go about the flat yield curve. Rates being very similar on the short end as they are on the long end. So why would anyone want to buy a 20 or 30 year bond or treasury when you can get the same rate on the short term and just keep rolling it over and compound the interest that way? But having a flat yield curve is obviously not healthy. It doesn't make sense. Why should you get the same rate for holding something for a short period of time as you do for holding it for a long period of time? And that tells you that you have a weakened economy when you see that. When you have what's known as a steep yield curve, when as it should be, you earn less interest for holding something a shorter duration than a longer issue. That's a sign of a healthier economy because, again, from just a pure common sense standpoint, that's more normal. So looking at TLT here, which, as you know by now, if you've been watching, is prices on the 20-year. Prices and yields move inversely. And you can see we're going down here in price, which means we're going up in yields and rates on the longer end of the curve, 20-year. And we also have a couple of things to note here, which I find quite interesting. I mentioned this yesterday, and we're already there today, that if this wave 5 is over, which it looks like it may, you know from Elliott Wave rules, if the wave 5 extends less than 100%, expectation is a retracement back to the previous 4. And that's where we are. We're right back to the previous 4. But is that going to hold? That's the key, because you probably by now can see that there's also a zigzag right here, where there was the A wave down and then the B wave right to 50%, which would mean that perhaps the TLT comes down even a little bit lower, all the way back, which would then satisfy this triangle rule here. Remember, when stocks break out of triangles, they break out whichever way they're going to do it, straight up, test it, move, false breakout, whatever. But after the breakout is finished, there's normally a retracement back to the point of the triangle. That's how it usually works. We haven't gotten there yet. We haven't come back to the point of this triangle. But isn't it interesting that the zigzag, the C wave of this zigzag, if we do continue to go down in price and therefore up in yields and rates, is right at the point of the triangle? It would take us exactly to that point. So we would satisfy the zigzag and we would satisfy the triangle rule. Makes a lot of sense. So that brings in the caveat of, man, the market doesn't always do what makes sense. But that would be a pretty clean pattern as far as what's happening on the longer end of the curve. Rick Santelli yesterday went through a pretty good analysis of some things that are going on with the yen, the dollar yen, having to do with effect on our rates. Japan is actually talking about raising rates, which, as you know, are, if you've been involved in the markets for the last, gosh, 10 years or so, they haven't done that very often, if at all. So that was kind of big news. So some of that plays in an indirect way to our markets. But what I'm wondering, and I think the data might start to show that out, is if the Fed is going to follow through, and there again was one tick up in liquidity, if that continues, as they said they were going to do, inject more liquidity, perhaps they're doing it on the shorter end of the curve. Remember, when the Federal Reserve injects or withdraws liquidity, they do it by buying or selling government bonds and treasuries. They buy bonds and treasuries to inject liquidity. They sell them, or in this case of their shrinking of the balance sheet in November, they just let them roll off, just let them expire, and then don't rebuy them immediately. So they let a lot of those bonds that they had purchased just roll off and disappear. And now perhaps they are buying again, maybe a little bit more on the shorter end. We are ticking up in rates on the 10-year. So this is TNX. And as a reminder, this is rates on the 10-year. So a little bit of a tick up here, not quite as severely as on the 20-year. And it's created just a small steepening of the yield curve. And that could be a good sign going into next year. if the Fed is going to continue to inject liquidity. They do cut rates in December, which is now the expectation. That's flip-flopped so much, as you're aware, I'm sure, from, yeah, they're going to cut again in December to didn't look like they were going to at all. Now it's back to it looks like they will. So if we start easing monetary policy, that should be beneficial to the economy. We're getting news each and every day, even though the next big non-farm payrolls number won't come out until after the Fed meeting, but nobody expects that to be good. The one that came out for September was a bit of a surprise, makes you wonder, because of all the announced layoffs. And they were also talking on the financial networks this morning that, a lot of people are talking about how companies are laying people off. One part to lean out a little bit, and second, because AI is taking away some entry-level jobs. But now they're starting to talk about how the effects of AI are lifting up and getting a little bit higher than just entry-level jobs. And then Zack mentioned OpenAI, all hands on deck, red alert, basically was what Sam Altman said. Yeah, people are coming after him with AI, and he wants to make ChatGPT much improved. There's been some comments of it's not always accurate with the information that you get there, et cetera. And so some of these other new AI modules that are coming out are gaining some market share. So the AI race just is going to continue. And it is, my opinion, in its early stages, even though here a lot of people talk about, oh, there's a bubble, there's a bubble. We have some overvalued stocks like Palantir, but NVIDIA's not. NVIDIA's right in a normal multiple range. We'll see how things move into the end of the year. But I do think we're set up for a potential end of year rally based on where we are at this moment. How all this affects the dollar, so far, so good. We're just sitting right here in this still Goldilocks channel. And as a reminder, someone said, oh, now I know why you talked about Goldilocks, because I made the comment, don't want it to go too far down, don't want it to go too far up, just right. Hence the Goldilocks reference there. This channel here, I think, is ideal for the dollar, for the markets to go higher. If the dollar gets too high, then it's going to affect earnings from the exchange rate. So many companies have international exposure now. We do have two zigzags. Wouldn't be surprised. We're testing the 50-day moving average with the dollar. If rates continue to tick up, at least on the mid to longer end, you could see that add a little bit of support to the dollar, and maybe we go up and hit one of these zigzags. And as a reminder, if we come up and satisfy these two zigzags, C waves, we're not that far away from going back to the previous four, which once again is the expectation if the wave 5 ends and doesn't extend more than 100%. So far so good on the dollar. Even though we had this little bit of a creep up here, it didn't get to the point where it was any sort of a major concern. It would. I actually think we'd probably be okay even if it goes up to where the previous four is. You might hear a few companies in the next earnings cycle coming out and saying, oh, yeah, they would have made their numbers, but the exchange rate, it's a convenient excuse if you miss your numbers. But I don't think it's that significant, just more of an excuse, unless we start to break higher from there. If the dollar really takes off and runs, then yes, it will have a significant effect on earnings. But we're not anywhere near that yet, so we'll worry about that down the road. For now, so far, so good with what's going on with the dollar. We take a look at the VIX, and we did break down below that 22.5 line. As a reminder, if you're wondering where this line came from, that's on the weekly chart of the VIX. So I just leave that on there to remember where that is. We went up and tested it, made a bit of a double top there on the VIX, and now we're right back down. We came back to the point of this triangle because we had a triangle in the VIX. And it works the same way, the technicals on the VIX, as it does on any other symbol. And now we're coming down here, testing in this 15 area. So something that might make you a little uneasy is that's held. But we have had extended periods of time where we just kind of trended around that 15 level and the market still went up. So it doesn't have to continue down for the market to continue up. But maybe if we rally into the end of the year and perhaps the start of next year, January, if we rally in December, be a little cautious on January, but again, getting way ahead of things. We'll see if we can break below 15 and trend down towards that 12 and a half level where we were last year, or if we continue to stay with this slightly elevated volatility in the market. Not a huge difference between 12 and a half and 15, but a little bit and enough to keep an eye on. So that's where we are on the VIX. Anything below 22 and a half, I think we're okay. We get these spikes up. If we spike back up to 22 and a half, yeah, probably a decent down day that would occur that day. But we don't have anything too crazy taken off to the upside, then we're probably okay. So the one thing that could change all this and my slightly bullish tone here is if the Fed doesn't cut in December. That would be a big disappointment to the markets, and we might see everything that I just talked about change and go through it in a completely different viewpoint. Looking at the DIA, moving to the upside here at the last week during the holiday week as well. Same thing here, going through a nice consolidation from that. You had the same volume situation here where we had the divergence here between the market going up and volume coming down. Bigger volume day yesterday on the downside move. Closed near the low of the day, actually closed lower than where we opened, which the S&P did not. The S&P closed lower, but not as low as the open. A little bit different here on the Dow. And we're kind of in this odd environment here with the DIA, all these 10-point blocks here. Every one of these represents a little bit of support, resistance, etc. So we got to bump our heads on 480 to break higher, but we got above 470 last week, 460 held, which was a nice area of support to hold. You can see all this support. If we didn't hold there, 450 was next, but we did. And so now we just watch to see, one, can we hold 470 now? And then two, can we break above 480? So hold 470, break above 480. I think we're kind of in no man's land here on the DIA. So if you're a Dow trader, I'm not sure there's much of a difference between the aggressive and more conservative views. The prudent view is to wait and see if the Dow can break above 480, and then maybe we're off and running. It'll be interesting to see on the DIA because that was an extended wave 5, 120% extension on the wave 5. Can we break that level? Can we go? That's why I think you want to wait and see how far we are able to run on the DIA. Just as a reminder, on a pullback, when the wave 5 does go beyond the level of 100%, you're not looking for a pullback to the previous 4. You're looking for a pullback simply to a fib level. And so I'll put the fib retracements on here, take some of this other stuff off so that we can get a little bit closer look at that, and so that the tool knows what are you clicking on here. And we'll see how far we've retraced as far as fib levels, and right to the 38.2% fib level. So those of you that may be newer to Elliott Wave, Fibonacci levels, etc., this is why I'm such a big believer in them, because you see it work time after time after time, and at some point you just have to say they work. They act as support resistance levels, Fibonacci levels, and Elliott himself was a huge believer in Fibonacci levels. And he was a mathematician, so obviously that makes sense. So in the rule here, we did come down, test 38.2, spot on, hit the level, So 470 could hold here. And perhaps we do head back to the upside, and we'll watch and see how that plays out. I'll go ahead and leave that on, put the moving averages back on here on the DIA. And then let's take a look at the Qs, see what's going on there. And here we have the same kind of scenario here as the SPY, where the wave 4 is labeled but still green. And you have to keep just a bit of caution. Again, prudent is the word, to stay just a little bit cautious, knowing that that has not been confirmed yet. And even as we move higher here, we have to wait to feel real comfortable that that turns green and solid and the algorithm thinks, yes, we are now moving into a wave 5. Also have a positive 1030 cross here on the Qs. There's been a bid in some of the tech names today, and it could be a good place to be again going in. We had a nice correction that needed to occur, got rid of some of the froth in some of the overvaluations on the moves down, and now maybe we're in a point where we can renew the bid in the Qs and move. This one looks pretty good, and this one I do think we can do the aggressive conservative viewpoint here with that cross, with this resistance level here in the 610 area. If we hold 610, I think you could go long here and look to see if the Qs reach up and hit that previous wave 3 high, and then maybe take it out. But your stop is quick. Your stop's right here. If we break below 610, then you're out. So when I look for an aggressive view, I always like it from a risk to reward standpoint, where the exit, if you're wrong on an aggressive entry, is pretty close by. So you would immediately get out. So yeah, I think an aggressive viewpoint on at least a move up here towards the previous wave 3, and then you exit if we break 610. If you're conservative here, you might be waiting a little bit too long. You might be waiting for it to go past this 630 level here, and maybe even higher from there. So we keep an eye on where we go in the Qs, but that looks pretty constructive to me. We look at the CCI, you can see how it's building higher. The reason, and I talked about this yesterday as well, but just to add it in there, I don't look at the DMI as much on the wave 5 trades where you're looking for the wave 5 extension, because you've just completed a wave 4 correction. And so if you have the wave 4 correction, obviously that's going to affect the levels on the DMI. And as I've noted in the past, the DMI is a bit more of a lagging indicator, where the CCI is more responsive to day-to-day movements. The two directional indicators in the DMI do respond from day to day, but the ADX takes a while. And so the fact that the ADX is still going down just means that it hasn't had time to turn and give any sort of a viewpoint on this potential extension back higher here on the Qs. So when you're looking at the wave 5s, I really put a lot of faith in the CCI. Where's it going? It's breaking above the 0 line. It's moving up towards positive 100. It's supportive, basically, is what's going on from the Qs. And then the IWM, which kind of bucking the normal trend. I've mentioned this in the past as well. I kind of use the Fed's moniker of the dual mandate, where they're supposed to watch employment and inflation. That's their two big things that they're supposed to be managing. And with the IWM, you kind of have two viewpoints. The IWM is the most responsive to rates of any of the markets. Small caps, small companies need to borrow money. If rates are higher, then it costs more to borrow, so they may hold off, but they need to borrow to grow and expand their business. So when rates come down, they tend to borrow. So oftentimes you will see the IWM move inversely to rates. So if rates are going down, it goes up. If rates are going up, it goes down. I've shown you that rates are ticking up, and yet we're kind of holding in there okay on the IWM, 245 being important. And then we looked at this yesterday, that same fib retracement, because the wave 5 went beyond 100% here as well. Perfect 50% correction. Look at that. Right exactly to a 50% correction level. So now what we need to watch on the IWM is, can we hold 245? We have that bullish cross there, the 1030 bullish cross, 10-day moving above, or 10 period moving above the 30, and a little bit overbought from the 10 period moving average. But if it can sit here around this 245 level and let the 10-day moving average catch up, maybe we're in a new impulse pattern to the upside here on the IWM as well. But this one, I think, of all the markets we've looked at, is a little more wait and see right now, as far as the fact that we have to take into account rates. The other side, the second of their dual mandate, is it's a good indicator of risk tolerance in the market. You hear risk on, risk off. A lot of people look for the small caps as an indication of what is the current risk tolerance for the market. And if we're moving higher, or at least staying sideways, even in the face of rates going up, it shows you that there's a little bit of a tolerance for risk at the moment. Obviously, that can change at a moment's notice, but for now, that's what it's showing. So we want to keep an eye on 245, but I think if you like to trade the Russell, you just kind of sit on your hands here for a few more days, and let's see if rates calm down for one thing, and if we can hold 245. I think that would be the key there, and something to look for there. Finally, some decent news if you're in the crypto market. Getting a little bit of a move up today, and just in time. We were really in danger, Will Robinson laying here on at least the BITB, the ETF that we look at for Bitcoin. So we came all the way down. We had an extended C wave. We had a 50% B wave correction on this zigzag. There was the 100% level. When you're in a wave 3, oftentimes you'll go down to an extended level. We don't have a wave 3 labeled here, so that's at least a little encouraging that maybe we've hit the bottom here, as all that liquidity was coming out. A lot of it probably being taken out of the crypto market. And if the Fed is going to reinject liquidity, I'd expect a lot of that liquidity to find its way back into the crypto market. So a nice tick up today, but as you can see, a lot of work to do. It's a good first step, but we need follow through, because we did this last week on Wednesday. We ticked up and then we were right back down again yesterday. So I guess that would have been Friday, and then right back down and then moving higher here. So we'll see if we can continue to move higher. I think the two constructive things, or I guess three if you add in the Fed injecting liquidity, but again, we don't have enough data yet. We just have an indication that maybe they are following through. But there's a run here from 45 up to 55, because there's a pretty straight move right back down, which I talked about in the past would kind of happen if we broke 55, because it had run straight up back in April. So there was nothing to hold it on the way down. Well, it works both ways. There's no resistance really to go back up to 55. And the biggest one here is pretty good separation here between the 10 and the 50-day moving average. And I talk about that 10-day or 10 period. Some people like to always correct me. Well, we don't all look at daily charts, so you should say 10 period moving average. And okay, old dog here, but no security in any time frame gets too far from the 10 period moving average, at least not for long. It works between the 10 and the 50 as well. When they start to get a lot of separation, they normally close in, just like the bars or candles, whatever you look at on your charts. If they get too far from the 10 period moving average, they come back together. Whether it's a retracement, whether it's a sideways move, allowing the 10 period to catch up, whatever it is, they come back together. The same thing happens here with the 10 and 50. But it also is the same where we could go sideways here on the BITB and slowly allow the 50 period to come back down and close the gap. But if you're long Bitcoin, that's not what you want. You want to see a quicker rally here back to the upside. at least there's something, because we've been talking about watch out if we break here, watch out if we break here. Now we're saying maybe, we're set up to where we can move higher. Same thing here occurring with Ethereum. Not quite the biggest move today, maybe not as big as in Bitcoin, but you can see here that there's still that same separation between the 10 and 50 period moving averages. And we also have this same area here where we had a big run up in July. So no resistance on the way down. We held that support level for now at 20, which really needed to hold, or we were really going to get ugly on the ETHW down there around 12 and a half was in play if we couldn't hold 20. So yeah, that would have been a wild move lower on Ethereum. It's trying to bounce as well. So no resistance back up to 25. Maybe we can get that. So maybe we can get some follow through here in the crypto market, which at least we have an encouraging day today. And then UNG, we are breaking above 15, watching this really, really closely to see we are pretty close to getting a confirmation day today, but we need to close higher than yesterday's high for it to be a valid confirmation or follow through day. And the concern I have is we're a little bit above the 10 period moving average here. It's not a lot, but a little bit. But I've been mentioning that if we could break 15 on UNG, I think we have a bullish trade up here to 17 and a half, but we had to do it first. And we were constructed well. Talked about this consolidating underneath 15 is what you wanted. You didn't want this upward movement here to continue and just run past 15 because those don't hold. It works a lot better when you consolidate under a resistance level and then break it. You have a much better chance of getting some follow through on the move, on the upward run, if that occurs. So maybe, just maybe, towards the end of the day, depending on what natural gas does, or at least UNG from here, or tomorrow, we could put out a speculative long position here on natural gas. So something to keep an eye on there. Oil, the big news, you heard me talk about this, was that trading oil to the downside made me a little bit nervous with the fact that OPEC could come out and decide to cut production at any point in time, just like on these two peaks. They increased production, but over the weekend, they decided to keep their production levels where they are. So they didn't decrease production, which means we could drift back down here on the USO and start to move lower. We broke out of the triangle. Not really much of a follow through day there. There wasn't one at all. So we broke down, back up, try to go down again, back up, and then up again. So there was no follow through or confirmation day. That's why I talk about this so often, because the market loves to give head fakes. It loves to fake out the weak hands or retail traders, etc., shorter term traders, all those. The market just loves to, kind of fool around with them, it seems like. But on a triangle, remember, you can break out and run. You can break out, test the breakout, and then continue back in that level. Or you get a false breakout and you run the other way. We still have this false breakout in play, but the fact that OPEC came out and said they're going to hold production steady, I think makes that a lesser chance of an upward move, more of a chance of a drift back down. But as a quick reminder, anytime you have a triangle, you don't get caught picking a direction, because the market loves to set you up and you go through the things that I just went through with you and pick a direction, and then it goes the other way. Any triangle can break either direction. So yeah, I'm giving some background and what could create whichever move it goes. And even though I think there's less chance of an upward breakout, it's still there. I suppose some could say, well, if you're talking about maybe the yield curve starting to steepen a little bit, if we start to get liquidity, if we start to get another Fed rate cut, all those things are bullish for the economy in general. Maybe that's enough to put a bid under USO. So you can find justifications for either move, but just don't pick one of them and let the market tell you. So you either trade a strangle as we're doing, or you just wait and let it show you, let it break out, and then trade the directional move. But if you're going to do that, if you're not going to do a strangle where you can make money on either way, if you want to wait and make it a directional move, you have to follow that follow through rule. And that's a perfect example of it there. It looked like we were breaking down. I'm sure the temptation was to go short oil, but no follow through day. And so here we are a bit higher than where we were last week. So getting to the metals, gold and silver, GLD had a little bit of a bid yesterday, giving some of that back. Today, I drew this arrow talking about where the wave 5 is. If we continue to break out, we got a little bit above the 10-day moving average. We're back down here now. That's good price action, if you will, as long as we hold the 10-day moving average and can continue higher. And once again, you can make a strong case for the metals going higher in an environment of increased liquidity and rate cuts. That could certainly keep a bid underneath GLD, but we're in this triangle. We did get a follow-through day here. You can see the upward break here. You could call that the follow-through day. You could call this the follow-through day. We have had follow-through here, so it does appear that GLD wants to go higher. So not quite the same caution as there was on the triangle from the USO chart. And then silver got a little bit ahead of itself yesterday, I think. You can see these two big vertical bars. I hate it when we do that. I much prefer, a creep up here, even though this was a little higher degree than 45. It's still better than this. So you could argue that, well, kind of trending sideways is pretty good on silver today. I would agree with you, but we're still separated from that 10-period moving average. So maybe another day or two of this backing and filling that occurs once you get too vertical. And it works the same way on a vertical upward move and a vertical downward move. So with that, Zach, I'm going to go ahead and turn it over to the Q&A. We will have our case study consideration as we do each week at the end of the webinar. So stay tuned for that. But for now, take any questions.
Yep, sounds great, Rob. Let's get right into it. Got a question here from Maria with your thoughts on TPR. Looks pretty bullish.
Yeah, except for today, Maria. And I think I think you asked about this last week, and I said we were going to watch and see if we broke above this 110 level, because right now we have a long January put left. The short put expired worthless. So we have a long put left. And it looked like that's where we were yesterday, breaking above that level, but we're coming back down today. Now, that may be nothing more than satisfying being a little too far from the 10-period moving average. But notice how the 10, 30, and 50 are all at the exact same spot. And looking here, we did come back down to the previous four with that wave 5 ending. So we've satisfied that rule. So that isn't helpful for moving down. But we are at resistance here at 110. So I think, Maria, we just have to watch another day or two. This may be nothing more than testing this 110 level. Then we turn and go higher. But we have plenty of room if it moves to the upside to flip that from the long put and go to a long call, because we're probably going to take off and run if we break above 110. So I don't want to jump the gun here while we're still maintaining this resistance point, and there's the possibility still that we come back down to support at least in that 100 level. So again, just another day or two here until we have a little clearer picture here on TPR as far as what's happening, because a bit of a down day so far, down over $3 at the moment on TPR. But like I said, it might be nothing more than testing 110 and correcting the slight move higher from the 10-day moving average where we were yesterday. It's not a lot. It's more about the 110 support resistance area, I think, than it is the separation from the 10-period moving average.
Thanks, Rob. And just a quick review going back to BITO. I know you covered it. Just to confirm specifically, is it just an oversold bounce?
Well, I looked at BITB, but same thing here. It's another ETF for Bitcoin, just a different company that produces it. No, I don't. It could be. With BITO, look at this wave three. It's pretty darn extended, and it got a bit vertical on the way down. Right now, it's an oversold bounce because we're not even back to the 10-period moving average on BITO. With that extreme, at some point, we're going to get at least a wave four bounce. And so we could get some continuation because like BITB, we have the same separation here between the 10 and the 50 period moving average. And to me, with where these cryptos are right now, especially Bitcoin, that's the most bullish thing. Obviously, it could be backdropped with liquidity injections, et cetera. But we don't have enough confirmation that that's actually going to occur. We haven't had the Fed meeting yet. But these two lines will come closer together, just like back here. You'll see the 10 period gets up, comes back down. 10 period goes down, comes back up. That's what I'm talking about. You can see this is what I'm referring to by the separation. And it always does that, just like the separation from the 10-day moving average. It's as close to, a golden rule as you can get in the world of technical analysis where nothing's 100%. These rules are pretty darn close. But it doesn't necessarily mean we run up and the 10 period goes back up to the 50. We could stay more sideways to where the 50 comes back down. But normally it's the 10 period that moves, as you can see. Like here it got too high, it came back down. Here it got too low, it came up. So it wasn't waiting on the 50 to catch up. The 10 period was leaving the way. That's how it works most of the time. Because nothing happens every time, just wanted to throw that in there. But I think that's the most bullish sign that you have here, that maybe this is more than just an oversold bounce. But to answer your question, that's all we can say today, is that it's an oversold bounce. But there is a case here for that this upward move could continue beyond just an oversold bounce, and maybe we get a bit of a run back up a little bit further, or quite a bit further here in Bitcoin. It's at least encouraging if you're long these. So be kind of precarious to short now. I think so much damage has been done. I don't know how much more to the downside we could go, but it doesn't necessarily mean we're going to run higher either. But I like the argument for a continued move up more than a continued move down right now.
Thanks, Rob. Next up, we have a month or so back. The trade was RIG, R-I-G. Any follow-up thoughts now that it popped?
Yeah, we just did on that one, was just a post, right? Either that or I forgot to put it in as an idea. Just had an idea and or a post thought, I guess, that could go higher. And yeah, I think with that move up, if you were in that, yeah, at 157% extension, we're getting awfully extended. I'd be looking to take profits here on that. Or at
Very
least
well.
tighten your stops. If you don't want to get out yet, at least, make the stops really tight. And that would be at the 10 period moving average would be your stop. We tested the 50-day, we ran back up, we got a little vertical, and I think we're getting a bit extended there. But if you feel like, maybe you could run more, just use tight stops so you don't lose the gains that you've had already. Still a supportive DMI, not not the most supportive setup there, but more supportive than negative. But look at the CCI. See how it's rolling over? And we've got a lower high there. So that is divergence on the CCI where we made, when you look at these two levels, this is good for talking about the CCI here. So there was the high on that peak on the CCI. And then we made another, two new highs here on rig, and yet we weren't able to take out that or even test that extreme point high from back in October. So it's kind of telling you that, well, it is telling you that the move from here to here was weaker than the move from here to here. And when you start to get that, it doesn't mean that stocks can't move higher in a weakened state, but it does tell you that be ready because a reversal or a pullback doesn't have to be a full reversal, but a pullback is probably in the near-term future.
Next up, we have AVGO, Wave 5 complete or just testing previous fib from completed Zig-Zag?
Yeah, that's a really good question on AVGO. It didn't have a very extended Wave 5 yet, so you could certainly make an argument that there's more to run. There's potential for a lot more of Broadcom to run. We did get a little ahead of ourselves here last week, and all we're doing now is coming back to the 10-period moving average. But the read here is, if that's all we're doing is recovering that overbought condition, we should hold on Broadcom here at 375. We hit it back in September, hit it in October. We broke through it in November. So that's the support resistance line, which coincides with the 10-period moving average. So I think it can stay constructively bullish on Broadcom as long as we hold 375. We break 375, then maybe that Wave 5 is indeed over, and then we're coming all the way back down here to 325. I don't think you want to wait for that to occur. So keep an eye on 375. I think if you're bullish, you can stay bullish as long as we're above that. And with the guys that perhaps just correcting a slightly overbought condition is all that's going on at the moment, especially with what's happening in some other tech stocks.
From there, let's head over to Wing, WING.
Wingstop. Pretty big mixed bag in the retail food area. Are people going to go out to eat? The negative here is that Wave 4 has been labeled purple here. So the algorithm is feeling like this is a good area where that bounce may end and we might start to come back down. So yeah, be cautious on this one and lean a little more bearish. We did satisfy the AI's target here. And as a reminder, if you're new, I know we have been adding subscribers on YouTube all the time and hopefully here at TradeFinder. If you go to hub.com, hubb.com, you get the software for free. You get the Elliott Wave labeling for free from the algorithm that Nelson wrote. They're not my labels. And you have an opportunity, if you'd like, to subscribe to the AI signals, but you don't have to get the software and the Elliott Wave. But the AI, look how it nailed that target. Said we're coming down here. We did rather quickly. And whatever reason, the AI identified that as a target and potential support. We acted. We did break down, but now we've come right back to it. And now at this point in time, with that Wave 4 being purple there, I'd be cautious on this one at this point in time. It doesn't mean that Wave 4 can't go up and go up to 61.8%. We could go higher. But for now, I think you have to lean maybe a touch more bearish here than bullish on Wingstop. The CCI is above that 100 level. So the likelihood, it still could tick higher than that, You can see this extreme point here shows that we're not at like an all-time or recent time high. But it looks more like to me that it wants to roll over than continue up. So let's keep an eye on that one and see if that CCI can turn and give us maybe a little more indication that see if anything's happening here. Well, the DMI is actually showing that there is a little bit of strength to that move. So maybe that wave 4 doesn't hold. But I think this is another one where we need another day or two here to get a little more confirmation on whether or not it can go higher. So the AI originally, I'm going to lean towards that at the moment. Oops, I didn't mean to turn it off. Had identified 311 on this downward move. That was your stop. So there's something about that level, which means we could possibly run up to that level. I guess if you have a belief in this stock and you want to go long it, that would be very aggressive. Your target would be up there to 311, but we'll see if we can get continuation. It is encouraging on the DMI, no doubt about that. That's a little stronger than you normally see in a wave 4 bounce. So yeah, I think I'm gonna have to hedge my comments a little bit on that one. I think if you wanted to be very, very aggressive, you could go long, but note that at the moment, even with a little bit of sideways movement here, slightly up, there's separation from the 10-period moving average. So at 273, we could test 250 again, even if we do end up moving higher on the wave 4. So a little trickier one there.
All right. See, a minute before time, still got some symbols outstanding for you. But as always, you tell me how many to pass through, and I'll be happy to do so.
We'll do 2 more, and then we'll do our consideration for this week.
Sounds great. Next one will be HL.
HL or O?
HL.
L, okay. Mining stock, I don't know if this is crypto mining or if this is actual metals mining here. I would assume it's metals based on this move up here. Doesn't seem to be moving with the crypto space at all. But from the technicals, once again, little separation from the 10-period moving average, but this sideways stuff is exactly what you want for this one to continue higher. That looks pretty constructive to me, especially with my viewpoint that moving into an easing monetary policy cycle, that we could certainly get a bid under the metals. The miners should follow along with that, and I think we could continue higher here. So I think that one looks constructively bullish.
Yeah, and you're correct. It's a silver producer.
Okay, yeah, that makes sense. So there's a little short-term tick down in the CCI, but the DMI still looks pretty supportive. So yeah. The only thing that could derail this, and I just want to throw that out there because the market's ever changing, and all we can do is analyze the information we have at any given point in time, is if the Fed doesn't cut. That could probably send the metals down, at least short term. Doesn't necessarily mean they're going to come all crashing back down. I don't mean that at all, but it could create a short-term pullback on the disappointment of maybe not as much liquidity coming in as expected.
Very well. Last symbol before heading over for the case study consideration is going to be Riot, R-I-O-T.
So this one is in more of a crypto land. And with this, we were in this before. Look at that AI score that we had, 78%. And it called it way back here at this point, and it ran all the way up. That was a nice trade. We got a little bit overbought, so we closed that one out. And then with pretty much everything crypto, really rough November. I do think that liquidity had a lot to do with that, with the Fed's withdrawal of liquidity. And now we're starting to move back up. And the wave 4 held just barely, but it did hold. And so this looks pretty constructive to me to move higher as well, especially if we can get at least a continued bounce out of the crypto space, whether or not we're quote home free yet or not. This one, you're above the 10 period moving average. You might have a little resistance here at the 50-day, but there was that vertical move down. Once again, see, vertical move up, vertical move back down, but no real resistance in the way, just like those charts of Bitcoin and Ethereum were. So yeah, I kind of like this one to continue to move back up from here. That looks constructive to me. I like that one. All right. So we'll look at today's, and this is going to be speculative. So it's not coming from one of the AI signals in the software. This is just my thought process. They were actually talking about it. Maria, you'd appreciate this. They were talking about the performance chasing this morning on the financial networks. That's going to probably start in earnest here as we head towards the we're past the Thanksgiving break. So we head towards the end of the year. Those investment managers that have underperformed the S&P need to get their performance back up to the S&P and beat it so they can get their end of the year bonuses. And they're going to be looking for places. And I think this is overdone in my opinion. There was the wave 5 that ended, and we just blew right through the previous wave 4 and consolidated nicely. We did break out a little separation between the 10 and the 50. It may not take off and run, but I don't think there's a whole lot of risk to the downside here either. So I think the worst case scenario is it goes sideways. If you're a credit spread trader, a bullish credit spread, I think would be ideal here, just in case it goes sideways. And out of the money bull put spread, something along those lines, would work out well in a scenario like this. But it's highly speculative and should be noted that way. But I think this could be a place that we could see a pretty good bounce as well for the performance chasers. Maybe some decent volume because from the data that's been released, there's a lot of investment managers that have underperformed the S&P this year, and they're going to be looking around for scenarios like this where they can get more bang for their buck, especially when they only have a month to go to meet their performance guidelines. So that's really the scenario there. You look down at the CCI, you can see we're drifting higher. You'd like it to be above the 0 line, but talking about divergence within the CCI, that seems to be the theme of this class today. Notice that each one of those extreme points was higher, so a period of higher lows on that, which comes into that volcano effect, the lava bubbling underneath. Even though the top of the volcano looks calm and peaceful, we don't see what the lava is doing underneath with an eruption getting ready to occur. And I think from a risk to reward standpoint, that's a place where you could put speculative money. I just want to highlight again, this is speculative. It's not following any of the rules that we talk about. It's just a general thing that you notice when you've been trading for a long period of time when you see things like this happen. So this has to be viewed as speculative, and I guess we could put this one in as an idea, Zach, and just note it as being speculative. Highlight the fact that this is not from any of our normal set of indicators, other than the CCI is showing positive divergence. That's about the most technical that we can come up with. The rest of it is all more on the theoretical side.
Okay, no worries. I'm happy to take over the screen and get this posted as a speculative idea. So we should be able to see my screen now. Here we are at the platform menu view, jumping off point of everything that this platform has to offer. I click this ideas light bulb up here on the right toolbar to bring us over to all of the ideas. As Rob said, we're actually going to go ahead and make this an official idea for today's session. That's going to be stock symbol TTD. And there we are. What was the target price again on TTD?
I didn't really list one, but we're going to go with 50.
50. Very nice. And time frame on that?
Let me change that. Let's do the 50-day moving average here. Let's change that price
Sure.
to 46. 46
it is. And how long do you want to go out on that?
We'll do 3 months just because if I'm wrong, I'm viewing this as a potential move through the month of December. So if it doesn't do it then you'd want to get out. So 3 months should be fine.
All right, so we'll go a quarter out. As we can see, we have that fixed interval of time that I selected. As always, we will come back and make this look more detailed with our supporting evidence and all the technicals that Rob's just went over. But I will go ahead and post this idea, or publish it rather, so you can see it is now available for you to come in and interact with. For those that have been around for some time, you've heard me say this a number of times now, but for anyone that might be new to either our webinar or to the Hub platform community, we encourage you to interact whether you agree or disagree with the idea. Opposing opinions is what makes markets. If everyone agreed, there'd be no transactions. It'd be an all buyers or not all sellers market, and that obviously would not work. So whether you agree or disagree, we encourage you to voice your opinion. Obviously, add your supporting details behind your opinion, and just be considerate of the ever-growing community. And Rob's highlighted a few times that the community here is something that I think everyone takes pride in, that it's no unnecessary banter or anything that in a negative connotation. It's just all very well thought out opinions rather. And again, whether you agree or disagree, we encourage you to interact. And it's great to see that integration continuing to grow. So I'll pass back over to you, Rob, for your final thoughts, and wish everyone a great rest of their trading day.
Yep. I'll take it back and just remind everybody what we're looking at here. We have divergence here in the CCI, climbing to the upside. We're just looking for a bounce back to the 50-day moving average. So that's our target, and we'll see how it plays out. So second, what Zach said, the community on the social media aspect of the platform is quite respectful on differing opinions, and that's great. And the platform grows every single day. More people are at it every day. So it's a great place to be. So thanks for spending some of your Tuesday with us. And as I've said for the last couple of weeks, we'll see where things close today, what that may tell us for the rest of the trading month. If we can mount some sort of a rally here into the end of the month. So